Okay, everyone. I hope everyone had a very nice lunch and has come back feeling refreshed and energized and ready for a good afternoon discussing all of the issues that we're here to talk about unlocking capital for climate action. Our next session on the agenda this afternoon is about de-risking private capital at scale for mitigation and adaptation. So a huge topic with lots of different angles to cover. And I'm pleased to hand over the session to Hong Tai Patterson, who is GCF's Chief Financial Officer and also Chief Operating Officer as well. So Hong, over to you and your panel.
So can everybody hear me? Is this on? Yep. So thank you everybody for joining this afternoon's session. I think it will be a very, very exciting one. I think if we can move to the first slide. So this is going to be speaking about, and I think some of you have heard me say this before. I hate the word de-risking, but there we go. But I do think that it is really important to lower that risk hurdle sufficiently to bring in private sector and really catalyze thank you, and catalyze investments at scale. So I guess a little bit about the GCF's private sector strategy, and then we'll move right into the session itself. The GCF is unique in the sense that it takes a country-driven approach in catalyzing private climate investments into developing countries and to meet the developing country needs. And we do this across 4 pathways. One is producing a conducive environment. And what that means really is allowing the countries or supporting the countries in their development and in supporting the countries in developing bankable projects. And so that is really important, not just in terms of, what we do from funding perspective, but preparing those countries in order to become investable. Then we look at accelerating climate innovation through investments in new and innovative technologies, business models, and financial instruments. And it really is meant to catalyze change in the market. Then thirdly is lowering that risk hurdle. And that's what I mean by rather than thinking about totally de-risking, it really is bringing down that hurdle sufficiently to really catalyze private investments into new unproven markets and mobilizing that financing. And then finally, strengthening domestic and regional financial institutions to scale up that private climate finance. We do have a very unusual toolkit where we will take positions on first loss basis, equity guarantees alongside the traditional grants, concessional loans and loans. And I think that this is something that's very unique to us. So going straight to it. Today we will hear from renowned experts in their respective fields, and they'll share their institution's experience in climate investments. We'll also focus on new initiatives in blended finance and innovation and get their take on how to mainstream institutional climate finance, which is really the key to unlocking that wall of cash that we often hear about to finance mitigation and adaptation projects in developing countries. So with that, thank you very much for your time. So on the roster today, we've got Wai Lang, who is the Managing Director and Head of CDBQ Asia Pacific. We have Oshima-san, who is the Managing Executive Officer and Head of Financial Solutions Group at MUFG. We have Hiro-san, the Deputy CEO for Credit Guarantee and Investment Facility. And then we have Anuj who's the VIP of operations for the Credit Guarantee Investment Facility as well. And then we have Cameron, who is head of ESG for Asia Pacific at Deutsche Bank. So thank you and welcome. So maybe what I can do is I will start off with Wai-Lang. If you could share with us how innovative platforms could unlock trillions from institutional investors to finance climate projects in developing countries. And I think CDPQ has done an amazing job at starting that already. So maybe over to you.
Thank you. If I could just pull up my slides, if that's possible. Thank you. If there are no slides, then I have to do it without slides.
I think somebody's helping with the slides.
Okay. So, for those of you who are not familiar with CDPQ, so if there are French speakers out there, we are actually Caisse de dépôt. That's right. And we are a pension fund out of Quebec in Canada. So, and the way we position ourselves is that while we are a pension fund, we are really a provider of constructive and long-term capital. And personally, I love the way, we have framed it as being constructive capital. And we are always very mindful that so we believe that there is a possibility of doing both constructive as well as being, very mindful about our returns. So that we believe that we can actually achieve both goals together. So if I can move on to the next, sorry. Okay, and so, yeah. All right. So those are the numbers. So that's how. So we are sizable, I would say. We are now about close to 400 billion, 391 billion Canadian dollars of AUM. As of June this year. So that's our latest numbers. So we are just slightly above 300 billion US dollars. And you can see that, we are actually, cutting across many international offices. So I myself, I'm based in Singapore. That's where our Asia hub is. And we've got offices in Delhi, in Sydney, and in Shanghai. So that's Asia. I'll run through some very quick numbers just to share a little bit. So I'm not sure whether you can actually see it from where you're sitting. Can anybody tell me if they can see it? Good. I'm just so mindful that this is an awful timing at 2 p.m. where most people will be quite full from lunch. And this is actually what I would call the graveyard shift. When it comes to being on a panel, but so I'll try my utmost. Now, when it comes to geography, so, we are, interestingly enough, we have made a very conscious effort to kind of move away from our home market in Canada. So by today, we're only 26% of our AUM is in Canada, and we are 44% in the US. But interestingly enough, in Asia Pacific, we're now 11%. Right, so that I think it's a respectable number. And in terms of what we invest in, we're roughly about 100 billion in public equities, another 100 billion or so in the fixed income. So when we say fixed income, it's not just bonds, but anything that gives us a fixed income-like return. So, the project that I'm talking about later on for blended finance actually falls under this team because we actually think that debt is a very good investment. And then we've got another 200 billion or so in what we call alternatives or illiquids. So that's private equity, that's infrastructure, and that's real estate. Okay, I will actually, I don't want to really talk about this too much because I think this is we are really very mindful about that we are our foremost in terms of our responsibility. It's to the 6 million, pensioners with us. That's out of the Quebec province itself. So that performance will come first and foremost. But on the other hand, we also believe that there is a way to be sustainable and to be constructive. So I'll talk a little bit about that. So this is what we talk about, that sustainable investment. We believe it's a key orientation. And we can actually generate values for the entire organization. So we are actually one of the first organizations globally, actually, that I have it in my bonus target in terms of the carbon intensity of our total portfolio. So it is, for us, it's really not just an exercise, it's not a lip service. So when we evaluate each and every single investment, we have it in our head that we are accountable for the carbon intensity. And obviously risk management. So everything that we do is also about managing our risk and to being responsible. Okay, so I would want to spend a little bit more time on, what Hong was talking about, blended finance. So I would, the caveat is, this is still very much work in progress. We are hoping that we will be able to get it live, up and running sometime next year. We've been working on this for more than a year. It's quite a challenging platform to put together, but we are confident that we will be able to get there. So why climate finance? We think that there's a 500 billion shortfall, annual shortfall in financing for climate finance. So, and that's for both adaptation and mitigation. So if we don't do anything about it, this gap is just growing, all right? And particularly if we're talking about emerging and frontier economies, honestly, I think we are all very vulnerable to climate change, but the developed markets really have a lot more means for adaptation and mitigation. It's really the developing countries and the frontier economies that probably need more of this financing. So this is what we're, and then on the left-hand side of what you can see, I think this is a known fact to a lot of us here out, in this room itself. What are some of the common obstacles that prevents these investments from being financed? All right, I don't even have to state it in terms of the government's capacity, and each transaction on its own tend not to be too big. Market accessibility, high origination costs, credit risk, and in there's also obviously, the preference to borrow in local currencies. And the challenge, I think there are quite a lot of bankers out here, that local currency financing out of a developing market or the frontier markets is extremely challenging. So that is why we thought that we, are putting up this particular platform to be able to offer some of the mitigating factors against all of these, what we see as the major obstacles. I'll talk through that. So in terms of limited government capacity, I'll probably jump to the next slide first. So I'll come back to this particular slide, but if you look at that, so blended finance, blended finance is a very interesting topic because if you talk to 100 people, each, I think most of the 100 people have different definition of what blended finance means to them. But to us, blended finance, it's really about institutional development and philanthropy. So if we can pull together as many of these types of capital, and so that each of us take different risk, accept different returns, so that on a blended basis, it is acceptable to the developing markets and the frontier economies. Because not forgetting that a lot of the frontier economies are very used to basically subsidies from the various multilaterals. And that's very, very real. And I'm saying that if I am part of the government, I would also want the cheapest, cost possible. But the problem is that the quantum is almost never enough to, for what the countries really want to achieve in terms of climate adaptation and mitigation. So that's where the blended finance platform comes in, where you're trying to rally different resources and to try to then come together and say that could we potentially provide a solution. Okay, now it comes to this, for very complicated chart. So, but do not feel overwhelmed with it. Now, upstream development. So the idea is that we're looking at forming an advisory group itself. So we have got local stakeholders. So depending on which are the stakeholders in the respective local economies, we have got financial partners, we've got climate experts, because again, these are very specific topics. So because ultimately all of these will need to be measured in terms of, if you put together a seawall, so, what's the financial impact? What are, how many people have benefited from this seawall? As an example, because ultimately all of us work for organizations that want things to be measured. And that's the reality of life. So I think part of that advisory group is about kind of putting all this together, because I think all of us in this room, we don't have all the answers to mitigation and adaptation. So it's about kind of forming a advisory group on this. And then if we move on to technical assistance. So again, this is where I think a lot of the local economies, you may or may not have the necessary expertise. So this is another thing that we have put together. So we are working with the Canadian Development Agency, who could help us with this on the technical assistance. And then we have got origination, obviously. We're building a network of partners that can help with the origination, or rather more importantly, the filtering of these projects. Because I think if I ask every single country for a wish list, the wish list gets very, very long. So it's really about filtering what are some of the most bankable, what are some of the, kind of trying to weigh and to get a very good balance between the bankable and also what's attractive to all the stakeholders. So that's where the origination comes in. Then when it comes to the financing bit, so that's where, you will have a capital structure where you have got private capital, and then you will have a risk return profile alignment. What do we mean by that? So that's where you have got concessional capital that will play a part. We will be tapping on guarantees facility. We are lining up potential providers of FX hedging. That's critical because that allows us to offer lending in local currencies without the local economies having to pay for a very high swap premium for the hedging, because that tends to be the killer for a lot of these financing requirements. And then on the execution, that is because, we are a fund, although we are 400 million, but we don't have a lot of people. We have got 1,400 people working with us. So clearly we won't be able to do quite a lot of the, what do I do? Okay, we won't be able to do a lot of the day-to-day, the execution. So we are setting up a transaction council, and we will be working with an independent asset manager to help us work through all of these. Okay, so this is actually another way of putting it, that these are the above, the top half of this slide talks about some of the potential barriers to private capital deployment. And then the bottom half of this slide talks about what are some of the mitigants that we're putting in place. Okay, so I think this is my last slide. And this is really an example. So, of what we're planning to do. So it's ourselves, we have got our private sector banking partner, we, potentially concessional capital, and everyone, Hong talked about the fact that GCF is able to offer a first loss, subordinated tranche first loss, and that is critical for a project like this. And then we will have a second loss tranche, and finally a commercial tranche. And on the site, you look at number 3, 4, and 5. That's where the technical assistance, the AVEX hedging capability, and the credit risk guarantees come in. The reason why this looks fairly complicated is that without all of these components, we will not be able to credit enhance these projects. On their own, these projects are we did a very quick analysis of all of these projects. At best, they are a single B project. So by building all of these potential mitigants and a blended finance structure, we could potentially upgrade it to a triple B minus. So that in itself, in terms of its cost of borrowing, is going to make a huge improvement to the various economies that needs this most. So I'm going to stop there. I think I overran my 7 minutes. So thank you.
Thank you very much, Maylin. So thank you for that. That was, I took quite a few notes on that. And I think that one of the things that you did hit on is that cost of borrowing. And particularly in the current environment where we're seeing a lot of these local currencies depreciate, and these countries are faced with imbalance of their FX reserves, that it is really, really important for them to access cheaper borrowing or less costly levels. So with that, I think that maybe I could ask Oshima-san, because one of the ways to do that is really through that guarantee. And so maybe Oshima-san, you could share with us why guarantee companies such as the Green Guarantee Company is required to unlock trillions from institutional investors.
Thank you. Is this mic on? Good. Thank you. So quickly, before I go into the presentation, my name is Ko Oshima. I'm from MUFG Bank. For those of you who are not familiar with MUFG, which is Mitsubishi UFJ Financial Group, we are the largest commercial banking group out of Japan. We're the 5th largest in terms of assets globally. We operate across 50 or so countries globally, and we have 180,000 employees. So if I can switch to the next slide, maybe is there one? Oops. Thank you. Thank you very much. As for MUFG, in terms of our relationship with GCF, we became a accredited entity in 2017. At that point, as a private sector bank, we are fairly strong in project finance, and we do like infrastructure and energy. But again, we come to notice that, the private sector alone isn't going to be able to solve all the issues. So we thought that, working for GCF as a accredited entity will help us, clients in terms of widening this, the borrowing scopes. And since then, we have 2 funding proposals and 1 project preparation facility approved from GCF. I'll touch upon one of them later on. I'm going back to a little bit about MUFG. This is about the banking sector, but we, as did many of our peers within the international banking community, we signed up as we declared our carbon neutrality declaration in May 2021, and that includes net zero of our greenhouse gas emissions in our finance portfolio by 2050, and also in our own operations, greenhouse gas emissions down to net zero by 2030. At that time, we also joined the Net Zero Banking Alliance, which is joined by many of our peers who have the same goals of basically going to net zero by 2050. Since then, we've been working on some of the requirements. 2050 is fairly a long way out, and we've been trying to, make milestones along that way so that we will be able to achieve that goal. Within the decarbonization through, our financings, we have set our own goal to, provide financing within our portfolio of 35 trillion yen. This is a period spanning from 2019 to 2030, which is a fairly long period, but it's a fairly large goal that we have. Out of the 35 trillion yen, 18 is earmarked for environment. And if we look within that, we have achieved 10.4 out of the 35 goal. But looking into environmental alone, it's about 4.3 trillion as of now. This portfolio includes things like, direct lending to renewable projects, and some of the, advisory work we do. Also, some of the green bonds that we arrange also are included in this portfolio. But again, even if we still do this, we believe that it will not be enough for, the goals that the world has for 2030 or 2050 in terms of carbon neutrality. Now, as everybody knows, there is a big financing gap, and this little picture tries to depict the situation here. The big dot, obviously, is this is how much outstanding there is in the global bond universe. The smaller yellow dot is out of that, how much is towards emerging markets and developing countries. So you can see it's fairly small. The dot in the middle is what is said to be required in the climate finance space. So the yellow dot is not going to be enough. So even if you bring together what has already been issued so far, it's not going to be enough to fill that gap. I know that the numbers, do fluctuate a lot, and there's a lot of different, ideas how this can be done. But I think, the fact is that the financing gap is very large. Now, before jumping to this green guarantee company, I just want to touch upon blended finance for what the effort we do from MUFG. We've been working with many of the MDBs, multilaterals, and all those entities during the past years, trying to arrange a blended finance in many ways. And as Wei-Lin just explained, it could mean a lot of things, and the structures, differ from transaction to transaction. But the way we've been looking at it, it's although we know that there is a lot of interest out there from the investor universe, unless the deals are investment grade, it is very difficult to sell these fairly long financing structures to some of these investors. So one of our focuses right now that we're working together with GCF is this green guarantee company. Basically, the idea here is that there's a lot of investment money to be mobilized, but again, probably it does require guarantees, whether it's a loan or a bond. These, there should be a guarantee provided to make the investment grade or above. And the idea here is if we could leverage the money capital of about 400 million, we'll be able to mobilize 10 times that amount as guarantees to these loans and bonds. So this is still in the works, and we have certain target countries listed here. Hopefully we will be able to, go ahead with this structure. There's still some hoops we need to jump through. But again, I think obviously this alone is not going to fill the big gap, but I think this is one idea that will bring about successful financings to these areas. So that's it from me. Thanks.
Great. Thank you, Oshima-san. And we are definitely looking forward to this. I think when I spoke to some of the developing countries, I think that they see this as being really, really critical to break that ceiling. So really great innovative work there. I guess if I dig a little bit further, maybe Anuj, you could share with us the role of local currency guarantees to address that financing gap that we're seeing.
Yeah, thanks so much for that. And I think I'll just start the presentation. So before the slides come, and since we are on a finite timeline, I'll just start talking about CGIF. So CGIF was actually set up after the thought of CGIF came up after the Asian financial crisis of the late 90s, where it was seen that a lot of corporate balance sheets were completely decimated because they had hard currency exposures on the books. So all the governments sat together and said something needs to be done to actually bring about the process of, Okay, so these governments which are there, they sat together and said, we need to actually get more issuances or more acceptance of the local currency capital markets in ASEAN. So they sat down, they talked together, and by 2010, CGIF was set up, where China, Japan, Korea, along with ADB and all the ASEAN countries contributed capital, which currently stands at about 1.15 billion, and that's been given to us, as which we manage. And on the back of this, we only have one purpose. So I can't think of any organization which is as focused, as single product oriented as we are in the world. The only thing we are supposed to do is promote local currency capital market issuances in the ASEAN +3 region with the objective of reducing currency risk and credit risk for the investors and also the issuers. With that in mind, I think given our capital and our strong parentage, we have been rated AA by S&P globally. We've also, because we are active in the region, in ASEAN, we've got ratings from all the major rating agencies in the ASEAN region. We use them very effectively. So if we go and do guarantees in Singapore, probably is the only market where we don't end up getting a AAA, but all other markets we're active in, we end up getting a AAA. Like I said, we are unique because our guarantees are unconditional, irrevocable. We cover all non-payment events, be it TNC risk, be it a missed payment by the issuer, be it anything which you can think of is covered by us, actually. There's nothing as robust as what we do. We can guarantee up to 100% of principal and interest payments, but there are deals where we've also done partial guarantees because markets like Thailand, which is slightly more developed, we can do partial guarantees there. In terms of our transaction parameters, since we are focused and our contributors happen to be from ASEAN and China, Japan, Korea, our issuer eligibility is here. But I think that's a big positive for us because I do believe your ambition should be global, but your execution should be local. And that's something which CGIF is able to do pretty well in the region. And the currencies which we support are, again, all the local currencies of ASEAN countries plus China. We can selectively pick Japanese yen, the CNH or CNY, and Korean won and do deals. And one thing to note is that as a guarantee institution, our single obligor limits are pretty high. We can actually do size if need be, but that doesn't mean we don't do small transactions. We've even done transactions as small as $10, $15 million, depending on the country where the trade is being originated from. Tenor up to 10 years and 15 years very selectively for project bonds and large infrastructure projects. We know we can go up to 15 years on those deals. So in the last 10 years where we've been in operation, I think the first guarantee was issued in 2013. So since then, we've actually done close to 2.8 billion, and I think we should be ending the year above 3 billion. If you look at the countries we've actually taken exposure in, Vietnam has clearly been a big success story for us because when we went and issued our first guarantee in 2014, there was nothing called a Vietnam bond market. But there's a slide afterwards where I'll show you how that market has actually expanded because CGIF acted as a catalyst. And there was a lot of local insurance companies which had a lot of VND investable surpluses, but didn't know where to put it. When CGI went and showed that there are a lot of large corporates in Vietnam which can offer you duration as well as better rates than what government bonds do, with our intervention, a lot of them started investing directly in Vietnam corporates. So that's something which we think, and we have similar stories for all the markets we've been active in. Cambodia, though it's small, but of the 5-6 issuances which have happened, 3 have been supported by CGIF. So I think that's very meaningful. Our portfolio currently stands above 2 billion, but yeah, it's growing and we will keep growing, I guess, going forward. We are pretty sector agnostic. We do not have any preference for any sector. But like I said, we are, we follow the market as such. And I think the market where we are based, there is a huge amount of investment which needs to be done in sectors like energy, transport, telecom, water. And we actually employed KPMG to do this research for us to see where the next pipeline is going to come. And because the theme of this conference is green and climate finance, all the sectors where investment is needed in the ASEAN region are key to doing it the right way. And that's where we believe that our intervention into this market as a provider of credit support would be very meaningful for the investors who want to come in and invest. And we can meet after the session or any time in the conference where we can actually give you examples of where we've actually been able to get overseas investors to come and take risk on local credits. So that's something which we will continue doing. And we know, I think over the next 10 years, there's enough for us to do. There's enough for us to do not only alone, but in partnership with a lot of other institutions. And we just want to promote that as much as we can. Just something I was mentioning earlier in terms of the potential of local currency markets. And I think Weiling also talked about the fact that the local currency financing is probably needed. So when we benchmark ourselves, since we only do corporate bonds, we still see it's a fraction in a lot of markets. And there's a lot of potential of growth there. So local currency capital markets have the potential to grow. Like if you look at Indonesia, it's the largest economy in ASEAN, whereas the local currency bond market is so small there. Now, even if you want to take them up to levels of, say, Thailand or Malaysia, there's a lot of issuances which will need to happen. And there's a lot of work to be done by institutions like us to actually promote local currency bonds in these markets and get the investor confidence going. So we are working on that. And I'm sure after 5 years, when I talk to you, this percentage should be much higher. So yeah, I won't repeat myself. This slide is just a very obvious slide which talks about some very obvious things. ASEAN currently is one of the fastest growing regions in the world. Access to capital markets, sadly, is limited to top tier companies. So if a middle market company or SME wants to actually go and raise money, especially if it's in the climate finance space or green space, it does not have the confidence of investors. Multilateral agencies and banks, unfortunately, still have a strong preference to do hard currency lending. So when I talk to the DCM teams of most banks, they will sit with term sheets which are dollars, euro, or yen. Now, that's something which we know is completely against our mandate because we've seen companies suffering. And that's been further amplified in the last 6 months or so, where dollar has been strong. And you've seen how the Asian currencies have actually moved south as compared to the dollar. So if somebody was sitting unhedged, they would have actually had to bear a huge cost because of the currency depreciation. I think there's a huge move from the governments of ASEAN to de-dollarize their economies, which is actually growing investable surpluses in local currency. So that is another thing which all financiers, be it for any kind of financing, will have to cash on and accept as a reality and take it forward. And that's something which we think is extremely exciting. And we're seeing even small markets like Cambodia, like last week, the Cambodian government, for the first time, issued a Khmer Real bond. They have never issued bonds in their history. It's a very small amount, but it's a step in the right direction. And the surprising part about a market like Cambodia is corporate bonds were issued before the government issued a bond. And the corporate bonds were issued because there were institutions like, say, IFC or CGIF who went and pushed these initiatives and got the corporates to issue the bonds before. So that's the impact we can have in promoting local currency financing. We are a catalyst. We work both for the issuers and the investors. Issuers, it's pretty obvious because if with our AA rating, you all of a sudden see a BB- company being rated to a AA when the issuance happens, and the investor universe changes, the cost of financing changes, They're able to diversify from the traditional bank funding. So there are lots of benefits for the issuers. When it comes to the investors, that's where we think we have a lot of value and we need to work harder to get that going across. We have about $1.35 billion with us because we retain all our earnings. Our contributors are damn nice. They don't ask us for any dividend or anything at this stage. So we just invest that in very safe A+ assets, which is very good for us. We are very protective about our AA rating. So whatever we do, we manage our risk very effectively. Just to quote an example of that, we've done 56 guarantees. And from 2013 onwards, and there have been multiple financial issues for ASEAN companies, but we've just had one default, which clearly shows that our risk management capabilities are actually, I would not like to boast too much, but they're better than what most other people would think it is. So we are very particular about that. And that's something which we want to maintain. What we can offer to a lot of multilaterals and partners is that we take the local currency risk, but we can write risk participation in US dollars. So if you are desirous of helping companies out raise local currency financing, we are there as a willing partner, taking the local currency, providing the local currency guarantee, but we can write a risk participation with you in dollars because our balance sheet actually is still maintained in US dollars. We have been helping a lot of local investors like insurance companies match their assets and liabilities. So that's something like if you go to a market like Vietnam, where insurance companies need duration because they offer only fixed annuity products. CGIF's intervention in getting long-term bond issuances done there has been accepted very strongly by these investors. And we have done a lot of foreign investors have actually come into the local currency markets because of our intervention. So the focus and the growth area for us currently, and like I said, since we are a subset of the market, we would be where the market is. And in the last 2 years or so, we've been seeing a lot of talk, even in the local currency market, on thematic bonds and climate financing. We've seen instances where the local rating agencies like RAM, Pifindo, TRIS, all are adopting ESG frameworks as a part of the rating methodology. I think this is a very significant thing because typically, ESG was something which was only being looked at by the multilateral agencies and then later by the commercial banks. But now when the rating agencies are forcing this upon and giving an opinion on a company's ESG framework, you're seeing companies becoming more compliant with these things everywhere. We have been pushing thematic bonds, and one big advantage we have, because we have been set up by the government as a trust fund of ADB under the Asian Bond Market Initiative. Not only do we provide the credit support for the bond to be issued, using the ABMI setup and the greater ADB infrastructure, we are also able to provide technical assistance and rebates for any certification of green or thematic bond which needs to be done. We are able to provide those kind of assistance to our client, our potential clients and the companies which we're supporting. And if, as I said today, I think I've got Hiro-san who manages risk for us also. Our pipeline hasn't looked more diverse than it was before, especially on the renewable energy space and on the climate financing side. We've got green bonds, social bonds, thematic bonds, everything coming. And a lot of them are to do with the broader movement which the governments have in terms of reducing carbon. So if you see our pipeline, it's extremely active in renewable energy, transportation, municipal infrastructure, healthcare, industrial upgradation. I think that's a big theme in ASEAN. Telecom, green buildings. We've got a bioenergy company which is needing funds from us to grow their setup, and even food products and logistics. So I think the sky is the limit in this area. And yeah, if anybody is out there, doesn't want to take as much risk to start with, wants a safe investment grade kind of an investment, doesn't want currency risk on their dollar portfolios, reach out to us. We'd be more than happy to work with you. Thank you so much. I think that's all I have to say now. Open to questions at whenever.
Great. Thank you, Anuj. I love the idea that it's creating a virtuous cycle for the countries themselves in terms of looking at how do you develop these countries and how do you support them as they do evolve and create investable markets. And creating a bond market is one of the main drivers for that. And so it does create a virtuous circle on that one. So maybe then moving to Cameron, as these as we start embarking on these innovative or catalyzing these markets, I think that one of the major needs is how do you fill that that financing gap? And I think that one of the best ways of doing that is really to diffuse a lot of these ideas and normalize them in the market. So maybe if you could talk a little bit about how we could mainstream climate financing in large commercial and investment banks.
Sounds great. Thank you very much for the invitation. I have 6 slides to walk you through my comments. The bulk of the focus is, since scale, doing green investments at scale is in our topic, I'm going to talk about what is happening in the private sector, private financing, specifically in Asia, hopefully with some examples. And then the last page is dedicated to us as an accredited agency. So a few comments, suggestions, which I think might be useful, and others can chime in on that. So focus immediately on Asia. I'm not going to bore you with how big the ESG market is and where it's headed, but at least in Asia, I want to show you what is the scale, what is the depth and breadth of what is happening with private capital. And then that sort of begs the question, we need to do a lot more blended finance and make the connection between different types of institutions. So first, what is driving sustainability in Asia? There you see on the left-hand side, 3 key things. First, if you look at the global supply chains, 60–70% of the global supply chain source out of Asia. If you look at FDI, foreign direct investments globally, 60–70% of that is coming to Asia, meaning the future manufacturing facilities of the world are being built right here in Asia. So what does that mean? As the world becomes more attuned to sustainability and investors and customers, consumers start demanding certain behaviors from the companies with which they, from which they buy products and do business with, there's a pressure on all of these multinationals, whether they're based in Asia or based in North America or Europe, to up their game with respect to sustainability. And that's driving business across the board. Apart from the foreign firms that are doing business in Asia and have huge exposure here, we also are seeing the rise of what I call the Asian MNCs, right? Multinational corporations from Asia, which are selling overseas under their own brand name. And when they go into EU and increasingly other markets, they're being asked to adhere to certain ESG standards by their buyers, saying, I can't really do business with you unless you meet these goals because I have my own requirements to meet. That's driving a lot of change here. In countries like Korea right here, most of the big corporations here sell overseas. They need to wake up. They're being forced to improve their ESG profiles. Third, we saw Europe move pretty fast on this ESG journey. A lot of it was also driven by the regulators there. So you now see a lot of regulators across Asia that are paying attention to this, working on things, and I'll talk about that in a minute. So what does all that mean, and what are the key challenges and key features of doing sustainable investment in Asia? First, the focus is here very much squarely on impact. This is a region that has gone through tremendous amount of economic growth in the last 10, 15, 20 years. So they have a very good understanding of what the E, S, and G problems look like in real life. And so rhetoric doesn't work. If you talk to somebody who wants to look at an ESG or sustainability investment seriously, they ask for data, they ask for metric, and they look for evidence. Second, this is a region where we do have to deal with transition finance in a very significant way. So how do you do this while keeping both your clients, your portfolio companies, and everybody else honest, that when you say you will do something, that you will actually do it? And then the third is, this is a very competitive region. So even the regulators have to worry about more than just managing the public interest. If you set up a very, very difficult and strict ESG regime, you'll only see companies moving next door. If you put in place a very lenient ESG regime, then people don't take you very seriously and you lose credibility as a financial market. So that's sort of driving this whole discussion. What have we done? So Deutsche Bank, of course, our strategy for Asia recognizes that Asia is very central to the global ESG market. So we set up a center of excellence in partnership with the Monetary Authority of Singapore in Singapore. And note that this center of excellence is not in Frankfurt, not in New York, not in London. It is here in Asia, because we feel that to do ESG in a credible way, this is the hardest place to do it, this region. And you need some firepower in the region. So people who can understand sustainability 2-3 layers deeper than a regular banker would, let's say. People who understand Asia, and then an authorized or set up organizational structure that is authorized to think outside the box. Because I can tell you, every ESG transaction that's worth mentioning is usually heavily customized to the needs of a particular company. And so to be able to do that, you need to know sustainability at pretty deep levels. We do a lot of other things, but one of the things I want to highlight is also engaging with the regulators. And you can see across the board, there are many that are not even listed here. Every single economy that I know of in Asia is in some shape or form thinking about regulations for the ESG market, both buy side and sell side. And we've been engaged, providing our advice, our inputs on what the global markets are doing and what people are expecting. So what's our business strategy? How do we operate? 4 key principles on the top left-hand side, all based on this concept of evidence-based, data-driven ESG. The days of general description that we are going to be green, trust us and give us money are gone. You need to have very detailed, granular substantiation of what you say you will do. So identify financially material ESG issues in a corporate or whoever the client is. So idea is not to provide a lecture on what is ESG, but to find a way in which you can put ESG into the commercial strategy of a company and make it better, make it more accretive to the value of the company. Second, there must be specific metrics that are tracked so that you're not just saying, yeah, well, this client said they were going to be green. Let's just hope they stay green. I mean, you need a lot more, and the smart money around the world is now asking these questions. Third, setting targets. So, when you talk about emissions, you can go to SBTI, the Science Based Target Initiative, and so on. But targets are necessary in a lot of different areas where we don't have SBTI. So you have to have people in-house who know what is material in which industry and how that can be achieved in what market through what metric. So that's kind of where we earn our living as ESG bankers, so to speak. And then finally, reporting. As I mentioned earlier, just saying I will do something is not good enough. It's not good enough for me. I think as a citizen, when somebody says I will do good, I want to see that you have actually done good. So data and reporting of that data is quite significant. In terms of our framework, we are signatories to almost every global convention that exists out there. We were the founding members of the Global Banking Alliance for Net Zero and so on. And we have our own taxonomy, of course, ESG taxonomy, which is very closely tied to the EU taxonomy. We have one set of standards for any transaction that we put ESG stamp on, and that has to be consistent across the globe. So there are no exceptions for any particular region. That's why it's important to have people who can keep the high standards, but are smart enough and experienced enough to figure out how to implement those high standards in environments like in Asia or other emerging markets. Now, just to give you a sense, okay, what does all that mean? Let me give you some numbers just from 2021, which was first 12 months of our runway as a center of excellence in APAC. In those 12 months, we did 138 ESG transactions in APAC, not whole of Asia, just APAC, with a notional value of 51 billion US. That is a massive number for this part of the world, I can tell you. And we're one of the banks only. There are other banks, obviously, doing that. So just to give you a sense of the scale. Now, I can't show you all of those 138 transactions, but what I can show you are these deals that won awards because these are public transactions. And you can see the diversity of the transaction type. So we have all kinds of bonds, ESG related, obviously ESG linked loans and so on, ESG linked derivatives. We've been leading in that space. Increasingly, ESG is showing up in M&A transactions. I have a live de-SPAC transaction right now with an Asian company that's doing a de-SPAC in Asia. So a lot of very interesting things happening here. All right, but this is not over. So the game is just beginning in terms of sustainability and ESG. So what are the key frontiers ahead? I would be remiss if I didn't highlight these. So first is harder to evade sectors. Cement, aviation, shipping. These are not easy sectors to reduce emissions from. So we are engaged with a number of clients on sustainable aviation fuel and carbon sequestration and green hydrogen and whatnot. A lot of work is going on, but this is to be completed work. Climate stress testing becoming quite significant. So when you think about and hear about ESG ratings of companies, it's important to understand what those ratings are showing is that if you invested in that company, how much is your money taking an environmental risk or social risk? Meaning it's a description of risk associated with the investment. It's quite different from what a company is doing to the world. What is the impact a company is having on the environment? That's a totally different world. We need a lot of work on that to be able to substantiate that. So people often confuse ESG rating of a company is very high. That means it must be environmentally very clean. That may or may not necessarily be true, right? Third thing, carbon accounting. I was at COP26 and there was a lot of talk about how the economies were not able to reach agreement on emission reduction targets and so on. One thing that was not reported very heavily was that there was unanimous agreement that carbon accounting has a huge role to play in this fight. And a lot of people have gone on to develop the new frameworks for carbon accounting and carbon trading. As you all know, 10 years ago, we as a global civilization experimented with carbon trading, and it wasn't a good experience. But 10 years hence, we have a lot more technology in terms of data management, artificial intelligence, machine learning, and just availability of data. So there's quite a bit of hope Yet, the key point I want to highlight here is that usually when we think of carbon accounting, we talk about what is called attributional accounting. So I change my fuel type as a company, I reduce my emissions, the reduction is attributed to me, I feel very good, my investors feel good. Okay, that makes sense. We now have to start thinking about consequential attributions, right? So because you change the fuel type to something, let's say organic, that organic product was used by some other industry before. Now they don't have access to it because you moved it to this particular industry. What will their reaction be? Are they going to indulge in activities that would be even more harmful or just as harmful? Who takes accounting of that? So when you say, well, I switch from this fuel to that fuel, you have another responsibility to see, okay, what consequences did it have? And net, was that a good thing for the world or not, right? Okay, so last page. Just so you know, we have been an accredited agency for quite a few years. We did our first investment with GCF last year. In fact, I went through all the craziness of travel last year to COP26 because we launched a fund there where GCF is a anchor investor, and we are, about I would say 80 million, and we're raising another 350 million on top of that. It's renewable energy in sub-Saharan Africa. So we've gone through the process. That fund is going very well, and we're now in talks about other investments that we will bring here. So these are comments as a partner. And I hope that my colleagues here on this panel and others would agree and add to this. So this is what, think of it as if GCF wants to work with the private sector, what is our, so to speak, wish list? How do we look at that partnership and say what creates value for us? First, of course, is the first loss capital. And that can take many forms, as you have heard today. Very, very critical, obviously, because blended finance is very important. I love the comment that, everybody is, if you talk to 100 people about blended finance, you'll get 100 different opinions. What I was thinking as an ex-World Bank staff and somebody who worked for a bilateral agency and the White House and so on, if you talk to those 100 people about blended finance, you also need to remember that you'd be lucky if 5 of them have ever done a blended finance transaction in their life. So there's a lot of learning to be done there, and having GCF as a partner is very, very good for the credibility as well. So what I would suggest, and we would suggest, is that GCF should think of leverage of private capital as a key indicator of success of your projects. It should not be optional. To get the true value for your money, you should really say, okay, doing a project on our own is good, but leveraging 10 times, 20 times our capital should be a requirement in terms of judging success. Second, investment approval process, it has improved a lot, I think. I must admit and give you credit where it's due. Predictability on timing of approvals and for investment proposals would be very helpful to know, okay, this will take 6 months, 10 months. Private sector likes predictability because without that, it becomes a pain. And then focal points, it's important to have an actual body that you can go to. And I know staff limitations are everywhere. So it's nice to think of it as either give them regional responsibility or sectoral responsibility so they also learn over time. One of the things we have witnessed is a lot of circulation of staff, which is not good for continuity. So anyway, that's on the approval process. In-country policy, once we raise the fund, for example, or have the capital, we have very little sway over government policy, but GCF does. You have the NDAs, you have direct contact with the senior representatives. This needs to be a continuous process because the return on the investments in the country depends very much on predictability and shape of the policy covering that area or sector. So please leverage what you have. Public outreach, when you work with a big private firm like ours, it's not like we need help. We would be able to cull 150 pages of an impact report into a 2-minute video or a 1-page posting, but it'll be good to be able to advertise it and disseminate it jointly with GCF. So again, I met with your communications team yesterday. Very happy to see they're very energized and very organized. And we said, we'd love to, again, have focal points, have a clear line of contact so we can get the message out of what GCF is doing. And finally, the grant component. And I know it's a sensitive subject for your board and everybody, but let me just say, for private sector, if even a small incremental improvement in the grant component will have significant impact on the quality of GCF's investment, significant, with all the leverages that we have just heard. So think about it, I know a lot of people with public sector backgrounds think of this as, oh, this is just subsidy for the private sector. It doesn't come to the private parties. It goes to the projects. It goes to the people who are going to actually build, especially when you start focusing on impact indicators and reporting on actual substantive data to back your investments. You need a lot of that prep work for the portfolio companies and others to be ready to provide that reporting. So anyway, I'll stop here. I hope this, like I said, this is in the spirit of partnership. We are very committed to working with GCF, and we want to continue to do that.
Great. Thank you, Cameron. I think it's a mark of the times when private sector, I thought last year when I saw the number of private sector players at COP26, but it is really a mark of the times when you touch on Article 6 in the private sector. So really, really hopeful. So we've got quite a few questions on the table. And I find it serendipitous, your intervention, Cameron, and then circling back with Wei Ling. So I think maybe what I can do is there's a couple of questions that are specific to CDBQ as well as CGIF. So maybe I'll choose one, which is the asset classes for CDBQ. What's the most interesting, or do you have plans to expand on those asset classes in the emerging markets?
Okay, I think when we talk about asset classes, I would say that one of the areas that we would, our depositors, our investors, their preference is to have more infrastructure. So already as of today, we are the world's second largest infrastructure investor. And we have room to deploy more. So that's the first thing. And if you look at what type of infrastructure do we invest in? So if I'm being very specific to this part of the world in Asia Pacific, I would say that we do the traditional infrastructure. So think of ports, think of airports, think of toll roads. So those are what we call traditional infrastructure. But the other area that we are quite a big believer of is renewables. So that is so for example, we have got a $1 billion investment in Taiwan itself, an offshore wind investment. So that's an example. So we are very much into solar, into wind, onshore, offshore. So that's the second. But I think perhaps more importantly for this group here is that we have also put aside $10 billion to do transition financing. That to us is the holy grail, because transition finance, I think, to start things afresh, it's probably way easier. But transition finance, we acknowledge, it's probably the most difficult. And I'm not saying that we've figured out how to do it completely. We're still learning. We're still trying to figure out how do we actually do transition financing in a meaningful and thoughtful manner. So, for example, this particular project that I've just presented on blended finance, the platform that we're creating, we are hopeful that, so out of the platform that, so the blended finance project that I just described, we're looking at 1.125 billion US of deployment. So CDPQ ourselves, we are putting up 600 million of the 1.125. And our hope is that this whole project of 1.125, we will be able that with every dollar of concessionary capital that will, have 4 times of private sector money. So that's really what we're hoping for. And so if we're successful with this particular blended finance platform that we're building, our hope is that a lot more of you out there in the public and private sector space can duplicate this. So it will be fantastic news if we can actually duplicate this by 1,000 times, 10,000 times, because I think the world needs that, and for every stakeholder to come together to play a part. So again, our acknowledgement is that it's work in progress for us. We're learning like everybody else when it comes to climate, when it comes to transition. And we're here to work with everyone subject to the fact that it has to meet our return hurdles.
So thank you for that. I think that in Canada in particular, transition finance is something that's very close to Canada's heart, especially given their transition period. So good to see that expanding into emerging countries as well. So the next question I'm going to give to CGIF, and maybe we can hear from Hiro-san, since with Anuja's presentation, so I'm testing Anuj, but Hiro-san, have you seen increasing appetite from overseas investors to local currency bonds supported by the CGIF guarantee? And are the overseas investors willing to assume local currency risk if credit risk is substantially mitigated?
Can you hear me, please? Yeah, great. Maybe Anuj is better positioned to respond to these questions, but certainly you have seen lowest risk appetite of overseas investors in CGF guaranteed bonds, but in certain currencies, particularly more liquid currencies like SIN-dollars, Hong Kong dollars, or CHN, offshore renminbi market denominated bonds, the risk appetite of overseas investors are phenomenal. We very much are looking at that kind of risk appetite for particularly recent transactions in CHN market in Hong Kong and Singapore. In terms of foreign currency risk, certainly institutional investors, overseas investors are exposed to the depreciation of local currency denominated bonds, but CGF is guaranteeing the repayment bonds if the payment default is triggered by the currency depreciation in given markets. Regardless of the cause of the default, CGF is there to guarantee the bonds or liabilities of bond issuers. So investors should not be concerned about the redemption of the bond, regardless of the cause of the defaults. So that, I think, responded to the questions. Anuj?
Yeah, so just to answer that question, like when we do bonds in a market like Cambodia, foreign investors are falling over their feet to invest in it. It's very difficult for us to place those bonds with the local investors. So that's something, and we have to be very strict about it when we talk to the financial arrangers, saying that if we are there to develop a bond market, we do not want to ignore the local investors. So we always have a certain amount of notional kept for the local investors. So these are things which we're seeing in certain markets, which we are active in, because getting a AA asset, which gives you phenomenal returns, is very difficult. Even if I compare a market like Indonesia, there are a lot of foreign investors who are keen to invest in government bonds issued by the in the market. But our coupon of the bonds, even though we are rated higher than the sovereign, tends to be higher than where the government bonds are. So net of withholding tax, the returns which investors end up getting on a CGIF guaranteed paper is substantially higher than what they would get if they invest in government bonds. So those are things which actually create the demand for our paper, and we are seeing substantial interest. There have been instances where Japanese investors have taken the whole tranche of an Indonesian bond, so I can quote them quite a lot, but yeah, we have seen quite a lot of foreign demand for our paper. And investors actually manage the currency risk largely on their own.
Great, thank you. So we talked a little bit about blended financing. So maybe if I move over to Cameron, there is a question on Huva. If you could provide us an example of applying blended financing linked investment at an industrial park level, if you have something like that in your portfolio, to maximize that impact. And I think brownfield investments are quite popular, actually.
Sure. So look, the blended finance, I have a lot of examples, but not from the Deutsche Bank platform, but from the World Bank or US Millennium Challenge Corporation and so on. There are a lot of challenges in doing blended finance properly, right? There is a issue of timing because certainly multilaterals or bilateral funding has a very different life cycle of approval, becomes a real issue for the private sector. Second is just understanding how to value and measure risk. You know, it's not something that in the private sector, we do this every day. We have a very good understanding of how to figure out what our risk appetite is. And the other side, they're used to lending with a government counter guarantee, or they're giving a grant. And now they have to go into a commercial transaction and take a commercial risk, right? So for us, there are a variety of different ways that are more practical. So the partnership with GCF is to us a very, very good example of the right kind of blended finance, where you put 80 million, we raise another 350 to 400 million. And then when the fund actually makes the investments, it makes them into project companies or projects where you get another 10, 15 times of leverage, right? So at the end of the day, the blended cost of investment and therefore the required return on that investment is substantially improved. That's a wholesale model, which we prefer. The retail model of doing one project at a time is very painful. I can tell you for any of the people here, it's very painful. It's not worth doing because it takes you so long to do one trade, and it takes about the same amount of time if you do it for a $50 million trade or a $500 million trade. So it's important to also think smartly about what, the extra effort that private sector has to make for blended finance must be worth it from a scale standpoint.
Thank you. And I think from a GCF perspective, we couldn't agree more. I think what we focus on really is trying to move towards a co-investment platform and making more systemic change. And it is very, very true. Working project by project is incredibly difficult. So there's a question here for both you, Cameron, and Oshima-san. What are the key challenges for both of you or each of you have in rolling out and implementing your commitment to the Net Zero Banking Alliance? And what can you recommend in terms of facilitating banks in developing countries that are signatories to that alliance?
Let me kick off. Probably, the biggest difficulty, I guess, is the unpredictability of things. A lot of in order to achieve net zero, in certain industries, you need technical advance, and some of them are talked about, are looked into, and people are working on it. But certain areas will need jumps in technology to achieve net zero. So I think, people working on it, and we do feel that it's possible, but we don't necessarily see it happening yet. So I think, I think that that's one part of it. Also, our belief is that we can't jump to net zero on day one. I mean, it's a process, and especially not just because of technology, but because of certain investments that are already been made. And, in Asia, for example, there's a heavy reliance on fossil fuel. And in certain countries, the process, you can't go green day one. So I think, how do you reduce your CO2, emissions during that process is key. And I think, although we did mention it, transition financing, although together with blended finance, there's a lot of definitions about transition finance, and what is regarded as a good transition financing still is being debated. So I think, getting consensus and, wide support about whether that financing is really contributing to, reduction in CO2 emissions overall alongst the milestones that each country has kind of, set, is going to be key. So I think, we do need to discuss that, and we need to, run all the ideas amongst many stakeholders and try to get as much consensus as possible. I think that's the key and difficulty at the same time.
So I will make three key challenges. First is matching our global commitments with country-based differences. So there are countries that say we will get to net zero in 2070. Pretty soon we'll have some countries showing up with 2080 kind of targets. And then they say, well, shouldn't we have longer timeline for this transition in these countries? And our position thus far has been we're only one bank, and that one bank has made a commitment to 2050. And that's what we're going to stick to, regardless of which market we are in. It's not an easy decision to make, but this is where we're headed. Second area is, frankly, I'm just going to be honest with you, the ability of an organization to say no when no needs to be said. And when I mentioned that, part of the reason for setting up the Center of Excellence in Asia was to have a unit that is authorized to raise their hand and say, this is not ESG, we should not call it ESG. Now, eventually it gets to our validation team, which is centralized in Frankfurt. So it would get killed. But in the meantime, you have a client that feels that they have a transaction that will be defined or classified as ESG, and then they get disappointed later because the transaction did not meet our own stated ESG taxonomy standards. So that's the second key area. I think this is an area that a lot of banks are grappling with, but pretty much coming to terms with it from the commitments they have made at the global level. The third challenge is data. I mean, as I mentioned earlier, as we get into more and more frontier markets with, carbon sequestration and carbon accounting and things like that, methane gas extraction, you have a technical problem that is being solved, but you also have an associated data challenge to actually capture that data so that you actually know that you have actual evidence to substantiate the claims, either by the financial institution or its client. And that's, I think there's a lot of companies coming up now who are dealing with quote unquote ESG data. So I'm hopeful that that problem will get resolved sooner or later. And banks have to also up their internal MIS, the management information systems, because they have never tracked non-financial issues. So they have a way of tracking financial risk, but now they are being asked to also track non-financial risk. So it's all kind of tied with that data question.
Great, thank you. And the data issue is real, and this is where I don't mean to use just ordinary words, but big data really comes into play here. So I'm gonna do a leading question to follow up on that. How do you see GCF's role in supporting you in developing countries on this? Yes, for Oshima-san and for Cameron. Just a follow up on that last question.
Obviously, as I said in the beginning, our whole objective of work starts trying to become a accredited entity for GCF was that we thought that, working together with GCF is going to broaden, the financing space. And I think that was true. And I think so far GCF been successful. I think the key here is how do we really, mobilize the platform much better? How do we really bring in private sector money into this universe is going to be key because, we're working on a number of projects to really enhance the platform, mobilizing a much bigger piece of the private, sector money into this sector. But hopefully we need a lot of support from GCF on that. So.
Two very quick points. One, wholesale strategies, not project strategies. And second, partner with us like a partner. Don't show up like a limited partner who just, has demands on process, but is not willing or capable of understanding the practical challenges that a fund faces or an investor faces. That's a big ask from an organization like GCF, but I think you can at least acknowledging it and making an effort towards it is good. You can't change your rules every night, but you can certainly adjust how you interact with your partners.
Great, thank you. I can always trust private sector for very blunt feedback. Thank you. So we have 3 minutes left. So I think what I would like to do is maybe wrap up on a few key items here in terms of the takeaways. I think that what we heard from Wei-Ling in terms of that structuring, I really did like that. Although it was a little bit complex, actually, when you dissect it, it really is fairly straightforward. But I think that what resonated with me is that development of an ecosystem, and it really talks about not just the project-based or looking at the programming that we're doing, but how do we create bankable projects in the first place? So really thinking through that upstream, how do we collaborate and get cooperation? And I think we heard the same thing from Cameron in terms of regulatory landscape and getting cooperation across countries. Cooperation in terms of taxonomy. And I think that that's going to be really important as well. And that's something that the GCF needs to step in more. I think that we do. We have that through our readiness programming, our PPFs, but that's something that is increasingly in demand, not just from private sector, but from our countries as well. Then I would say that financing gap, I did really like your comment and Anuj in terms of thinking global, acting local. And I think that was very, very timely, especially as we think about how do we have a real impact into these economies, and how do we and how do we actually create that virtuous cycle in terms of gaining that economic independence for these countries. And then I guess in terms of that first loss capital, I think we heard it across the board here, that structuring is really, really critical for us in supporting that or catalyzing private investments into climate finance and normalizing that. So hopefully I was able to wrap things up. Thank you so much for your time and for the detailed information that you provided. I think that there's a lot of desire to hear much more. There's demand for the presentations alone. So please take this time, everyone, to approach our speakers to ask much more detailed questions. So thank you very much. A round of applause. Thank you.
Thanks, Hong, and thanks everyone on the panel. We're going to take a short break now, so you have half an hour to go and grab a coffee, which I'm sure is not needed after all of that, but we'll see you back here at 4 o'clock for the last session of the day. Thank you.